Hi, welcome back. In this lesson, we shall talk something about the payoff diagram for the two strategies which we have studied in the previous two lessons. That is the bull call spread and the bull put spread. Now my request is that if you have not understood these two previous lessons very well, then please try revisit them, understand them very clearly, because unless you understand both the strategies, you will not be able to understand the payoff diagram. All right. So coming to the payoff diagram now, what you see on the screen, the x-axis is the price of the underlying asset, be it Nifty or Nasdaq or any other derivative or a stock, whatever it is. Since we were discussing about Nifty, I have taken the price of Nifty, the price at expiration. Nifty may expire here, it may expire here, it may expire or anywhere along this line. Okay. And this y-axis, what you see, is the profit and loss. Above this point 0, you are in a profit. Below this line 0, you are in a loss. So the example which we had taken, in that case, our maximum profit was 6722 and the maximum loss which could have been was 3278 or 3277, whatever. That's why I have put this figure, no other reason. Now what you see in this blue diagram, that is the payoff diagram for the bull call spread strategy. Let me try and explain it to you. See, this is the point where we entered into the contract at 16250. When Nifty was at 16250, we bought an ATM call and we sold an out of the money call. We paid a higher premium and we received a lesser premium. Therefore, the net result was that we were ultimate payer. That means we were in debit. We had to pay a premium from our pocket. That's why we are below this line. And how much was that premium paid? It was 3278, whatever. Don't worry about this figure. Just try and understand the concept that initially when you entered into the position, when you entered into the spread, you had to pay from your pocket this much money. All right. Then as the price of Nifty increased, at some point you became break even because you started gaining. The moment Nifty started going up, the Nifty started increasing here, you started gaining, and at some point it became break even, no profit, no loss. And as Nifty increased further, you started gaining a profit. All right, Nifty is increasing here and you are gaining a profit. Beyond 16450, your profit was stable. On one hand you were earning, on the other hand you were losing, and your profit became stable. Under no circumstances your profit could go beyond this. Okay, so this was the maximum profit which you could earn. And on the negative side, if the Nifty went below 16250, this was the maximum loss, the premium which you had paid, which you could have lost. Under no circumstances you could have lost more than this. All right, so the entire picture is clear. How much could have been your maximum profit and how much could have been your maximum loss. There is no undue risk or ambiguity regarding going bankrupt overnight. Okay, the point to remember here is that even if Nifty closed at this point where you entered into the position, you would have been in a loss. If the Nifty went down, again you would have been in a loss. You would have been in a profit only if Nifty went up. So therefore, you had taken this position because of a bullish view. All right. Now let us come to the bull put spread. Exactly the mirror image. Okay. But the difference is we went into a contract or we took position at the same point 16250, what we had done here. The difference is that in this case we were net recipient of the premium. Okay, because we were dealing in puts, we received a higher premium and we paid a lesser premium. So ab initio or right from the beginning, there was money in our hand. there was credit in our account, money came into our account, this much. All right. In the previous case, this much money had gone out of our account. Here, ab initio, the money has come into your account, the premium. And then, if Nifty increased, your profit remained the same, no going beyond. The maximum profit was the amount of premium which you had taken. So again, the view was bullish. Okay. But just in case Nifty went down or the price of Nifty went down, then you would have had to return the premium. As Nifty kept going down below 16250, you would have had to keep returning the premium. And at some point of time, you would have been break even. No profit, no loss. Here, when you entered into the position, you were into a profit equal to the amount of premium received, net premium received. Gradually, if the Nifty went down, you kept on returning the premium. Here you are no profit, no loss. If the Nifty went down further, then your losses would have increased. But under no circumstances your losses would go below this, because again you had taken two positions. So one would keep earning for you, the other would keep losing, and you would remain stable at this level. All right. And similarly, your profit could not have increased more than this, more than the amount of premium which you had received. So again, a very clear picture. You know how much could be your maximum profit, and you also know how much could be your maximum loss. So there is no ambiguity. All right. Now, what is the difference? In this case, if the Nifty expired at the same place where you had entered the position at this 16250, you would still be in a profit. If the Nifty increased, you would be in a profit. But even if it expired at the same point, you would be in a profit. In the previous case, you would have been in a loss if it expired here. You would have been in a profit only if it increased. So the view is bullish here also. The view is bullish here also. But the difference is in the perception. In this case, you will gain only if Nifty goes up. All right. But if Nifty remains at the same position, you are losing. If Nifty goes down, you are losing. In case of bull put spread, you do not want Nifty to go down. If it remains at the same position, still you are happy, because if it remains here, still you are retaining the premium. If it goes up, again you are retaining the premium. You just don't want the Nifty to go down. So got the difference? So I hope this concept of bull call spread and bull put spread is absolutely clear to you by now. Use your imagination and you can keep on playing around with this. All right.